Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. It's been a interesting week, to say the least. I think actually not that much activity in the larger market cap weighted indexes, which give you a picture, not a complete picture, but it gives you a picture. They've actually done very well over the past 5 years, quite frankly. They've outperformed just about everything. But the reality is the smaller mid-cap stocks, equal-weighted indexes, they're starting to pick up some ground here. Active management starting to pick up a little bit. That's a good thing, especially if you're not in 100% index funds, well, which is not a horrible bad thing. We're going to be talking about that at an upcoming seminar, which is coming up relatively quickly. And actually, I have to go back and find out when that is. I know it's a Saturday morning. This goes to show I try not to memorize much at all anymore. If I've written it down, I really don't like to try to memorize it. There's so many facts and figures going around in my brain most of the time. It's relatively difficult to do that. So anyway, July 22nd. That's Saturday morning. It's at the Corporate College, East Side. We're rolling out I'm going to actually introduce a platform there that we are slowly rolling out because we're actually still learning it ourselves, which will be an ongoing process because this thing is really comprehensive. In addition to the asset management that we do, we're going to give access to people to this service that's online that'll do just about anything that they want it to. You can store documents online, which I think is a great tool. If you don't have the ability to scan your own documents, clients of ours will scan it for you, post it up on your own personal website that you set up that you can access. You can see all of your accounts in one place, which I think is very neat. You can track your spending there. I've been tracking my spending, and that's kind of cool. In fact, there's very little it won't do, which is why we've been talking about it for a while, and we've actually tried this several times. But the software itself, the services, weren't really ready. I mean, they kept breaking down the links between your financial institutions. That still happens, but now it's easier to fix. And anyway, I'm going to be talking about that and showing that. I've built in to comply with Department of Labor, the rules. I've built a new model we're also rolling out. You should start to see some of those things. If you're a client, you're going to start to see some of those things next week. So we're going through each week. I'm going to take about 10% of the client base, send everything out. It's not a life or death situation, by the way, and there's really no big hurry on it. It's not going to make a gigantic difference right away, but I think that over time, it should help us make more money. That's the bottom line. It should help us make more money. We're not allowed to promise that. All we can do is try. And I think it's time. The financial services industry has been evolving constantly. Actually, it's changed dramatically just since I left, actually, over the past 5 years. Past 5 years, our industry has been slowly changing. Nobody's really noticed it much because the media hasn't given much press to it. There's so many other more interesting things going on that they're not really paying too close attention, but there's some big changes. And we try to keep up with it. We're going to be unveiling those changes, how we're planning on dealing with it. And quite frankly, it's getting better. It's getting easier. Not that it's easy, but it's not as difficult as it was a few years ago. So, and you'll know more about that if you decide to go to that workshop, July 22nd. That's a Saturday morning, bullingtoncapital.com. Feel free to come. No, nobody's going to call you afterwards, by the way. In fact, we have a fairly difficult time calling back the people that want us to call them back. and because we try to get back to everybody within 48 hours, and that's a minimum. And if it's an emergency, you can tell us it's an emergency, and we'll call you back immediately. So anyway, go to thebullingtoncapital.com to find out more about that. I think it's one of the few times in my career anyway, which is a long one now. It's one of the few times I can see where government regulations have come down and have actually helped the business. I really believe this is going to help things overall. Is it going to be restrictive? To some people it will be. It'll be a little more restrictive. But I think when they start to look at the restrictions, if they look at them objectively, I think they're going to find out that, it's a pretty good thing. It's a pretty good thing. And I'm very optimistic about the economy right now. It's been doing very well. I've been hearing some rumblings. I have clients that are in various industries, one of them in the lending business, and a little nervous about some of the reduction in requirements, for qualifying for loans. Now, the general public goes, yay, and the bankers start to worry. Because when you loosen up on the standards, everybody knows what happened last time that happened. But I've got to tell you, there are some compensating factors here that they may not be aware of, might not be looking at, and I think that's important. I think it's important that Janet Yellen says that not only are they raising interest rates slowly, 0.25% at a time, they're still not very high, but they're better than they were a year ago. If you're looking for CDs, makes it a little more difficult to qualify because the payments then go up on mortgages. And the thing that's most interesting, which has not gotten a lot of interest by the media in general, is that the Fed announced a few weeks ago that they were going to start to reduce their balance sheet. Basically, some of the mortgage-backed securities that they bought from the troubled banks, they're now going to be selling back to the banks. They're going to reduce their balance sheet. They're going to get cash for those bonds. Now, the good news is most of those bonds are paying higher interest rates than the loans that the banks can make to the general public. So the profit margins should go up. That's the good news, and that is a very positive thing. The opposite side of that is that money is no longer available to make loans with. Once the bank is buying those securities back from the Fed, they have less money to make loans with because you can't loan it and borrow it at the same time. Unless you're Bernie Madoff. We all know how that ends up. But anyway, so I don't think that tells me that the Fed is incredibly confident in the economy if they're willing to do both of those things at the same time. So and you look at real estate sales, real estate prices, they've been recovering very nicely. You look at overall GDP growth, it's accelerated a little bit. I read a publication that's put out by Bloomberg, top CEOs in America. Most of them are more optimistic. I can tell you that I've read more articles from these guys, and they put out this thing called an Orange Book once a quarter. It's just they interview CEOs from the top several hundred companies across the country just to get their take on what they see in the economy and what they're doing in their business to react to it. And one of the themes that seems to be relatively common is that they're investing more in businesses, whereas the previous 4 or 5 years, many of them had been buying back more shares of their own stock instead of investing in new businesses. And when you buy back your own stock, that drives the earnings per share, the profits per share up because you don't have to split the profits amongst fewer shareholders. That's a good way to get your earnings to grow in the short run. Sooner or later, you're going to have to grow your business to get those earnings to grow. And it can be a long time, by the way, but when you have to switch over. But it appears as though that seems to be a common theme, that more businesses are out there looking for opportunities to expand and grow their businesses the normal way or the organic way. improve what we're doing, come out with new products, invent new products to go along with the existing products. Let's buy little, privately held companies and put some money in it to develop that as a product line or a service. And that's a good thing. I like seeing that. Unemployment numbers good. It's pretty good. And don't know if it'll continue on this path, but that's the one we're on right now. And it's a good time. I think it's a really good time. Stocks are not super overpriced. Some of the market cap weighted stocks are overpriced, but not by a lot. It's not like it was back in 2000. It's not like it back, in 2006. If you looked at the valuation on the large banks, most banks, the valuations were significantly higher than they had been even when the banks had crashed in the year 2000. Housing company stocks were selling at the highest valuations they had ever sold for, ever. Okay. That was a big bubble. When that bubble popped, you all saw how important those two industries are to the economy because that sent everything else reeling, which was interesting because that was different. That was different than the year 2000 when technology kind of fell apart. Technology, energy, banking stocks fell apart during that time period too, but that was just overvaluation. It wasn't because the loans were going bad and they were losing gazillions of dollars. It was a different story. But 2000, it was kind of limited to a handful of industries that had become a large portion of the stock market because of their values and the way that most people invest, and the way the big institutions invest. But you could have avoided an awful lot of that decline in 2000. That was relatively easy in 2006 and 2007, 2008, 2009. 2006 is when the mortgages started going bad, by the way. 2007 is when everybody realized it right near the end of the year. And that lasted for, that was, how many months is that? About 15, 16 months. Chinese water torture. We saw the devastation that occurred in those two industries, but those two industries affect almost all other industries outside of technology, by the way. Technology just gets affected by GDP growth, which contracts. So anyway, that was a big difference. It was banking, housing are a huge chunk of the economy, both revenue, the number of industries that are affected by it. Technology, we're all interconnected, but technology had a smaller overall impact on things like unemployment. Anyway, they're close, but banking and financial services and housing together with all the other industries that they affect had a bigger, nastier impact than what had happened in the year 2000. Although financially, the stock market reacted the same way both times. It overreacted, incidentally, both times. And it had the same overreaction twice. And one of them was actually significantly more difficult than the other, and that was the second of the two to survive. So don't see that happening right now. Bank loan growth is still kind of flattish. If it's bank loan growth gets really high and then the non-performing loans start to creep up again, that's not good for an economy. But we're not really seeing that yet. And I look at the stock market itself. It's actually getting stronger. The areas that have not participated over the past 3 or 4 years look as though they're getting a little bit stronger right now. We'll talk about that in a little bit. Right now, let's see. I can't remember. I think I have to. Do I have to go to a commercial soon? Yeah. Oh, I've got 4 minutes. All right. Got 4 minutes, so I can take a phone call. If you'd like to call us, 216-901-0945, 216-901-0945. Going to Andy. Andy, you have a question for me?
Yeah, good morning, Bill. I wanted to get your thoughts on the financial crisis in the state of Illinois. And I know a lot of it has to do with unfunded pension liabilities, and that seems to be a problem across the country. I just wanted to see your thoughts on that and what impact it might have on the financial markets going forward.
Well, that would be really, really difficult to tell because Illinois is just one, I don't want to say a small part because, Chicago is one of the bigger cities in the world. But it's not going to have a gigantic impact on everything else. Will it have an impact? Yeah, it's going to have an impact. Is it going to be huge? Probably not so much. it would be very hard on the people of Illinois because you can bet that at some point in time, it's going to translate into higher taxes in some way, shape, or form, because that's the way that you work yourself out of that. So I think it'd be really much more difficult to be a citizen of that state because, and everybody's going to have to participate in that. And they may end up getting some government money and government assistance in there sooner or later. But when you look at I'm not sure what the economic output of the state of Illinois is relative to the rest of the country. I'm sure because of Chicago, it's probably a little larger than a lot of other states might be. But, you've got 50 other states. In fact, you got 10% of the population lives in California, by the way.
Right.
And California's got they got a ton of problems too. Everybody has problems. If you got humans, you have problems. But it's not the end of the world. And in fact, they're in better shape than everybody thinks they are because you can't sell ads unless you scare people because they are immune to anything. And good news, they don't pay attention to at all. Good news is like, I skipped that story. And so the bad news, you have to, they're basically scaring people. Is it a cataclysmic event? No way. Not even close. Is it going to be uncomfortable for some people? Yep. But it always is. I mean, think about it. In 1945, after World War II, what do you do when you get home and all you know how to do is shoot a gun? I'm just kidding. But you didn't have all the industries that we have today to look for employment. And that was tough. Those were tough times. GDP was actually, let me put it the other way. National debt was 145% of GDP. Right before we started this thing called the Marshall Plan, where we started giving money to foreign countries. We didn't have all these other industries to generate the revenue that we were giving away back then, and we were 145% of debt to GDP. You know what? We'd have to add a couple $1 trillion to our national debt today to equal that. Mm-hmm. And so I'm not worried about it. What worries me is when the loan growth starts to stall or the percentage of bad loans starts to creep up. That's worrisome. That's what happened in 2008, 2009. It's fixable, and they are going to fix it every time it happens because our system is set up that way to be able to fix it. The net result over long time periods is inflation. That's the real risk that we all face. Prices going up and our assets not keeping up with that. That would be a pretty big risk. But hey, I got to take a real quick commercial break. Did you have anything else?
No, that's it, Bill. Thanks very much.
All right. Hey, thanks for calling. Listen to Bill Bullington. I'm right here on 1420 The Answer. Stay tuned because I'll be right back. And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. You can go to my website, bullingtoncapital.com, if you're interested in going to a seminar coming up soon. I think it's the 22nd July. That should be a lot of fun. We're going to be unveiling something we've been working on, actually a couple things that we've been working on for the past several months and putting in a lot of overtime. So should be interesting to see these things. One of them is a tool that you can use to organize your financial life. We're going to use with all of our clients at some point in time. Now, when I say that, this thing is really powerful, and it takes an enormous amount of time, effort, and energy for us to realize because we have to answer your questions. So that's why, I have been talking about it. We still haven't rolled it out to a lot of people yet. We're going to start this week, and you'll be getting access to it relatively quickly. But we're going to talk about it at seminars going forward because I think it's a really good idea. And that's one of the things that we'll be talking about. Also be rolling out, I have Department of Labor portfolios that kind of match what the Department of Labor, at least our interpretation of what the Department of Labor has been requiring or requesting. And it's going to be interesting to see what that is. I'm looking forward to it. Actually, I think it's going to help. So those two things are going to be coming up at that workshop. Feel free to go to my website to find out more about it and sign up. There's no cost to attend. No salesman will call, I promise you, unless you ask us to. You have to ask us to, though, by the way, because we're not going to call you out of the blue. Anyway, I'm going to go right to the phones. If you'd like to call in, 216-901-0945. And I've got Phil. How you doing?
Bill, what are you doing over there?
Oh, just trying to keep my head above water.
I got a question for you. Something you talked about a couple years ago. We got in it and whatnot. I read an article about MLP recently, and with the slide of the slide this year of crude, even though they're not connected directly, they have been taking a bit of a
They've moved
beating.
in line. Yeah, they've moved almost exactly in line with crude prices.
So here's my question: you think we have an opportunity there with something?
Well, I still have mine, and I've still been reinvesting the dividends, and I've still been adding to it. Which is, as you know, has been very painful. But I mean, their revenues are a lot higher than they were when I started investing in them. The dividend yield is higher than it was when I started investing in. The only thing that's really changed, a few of them have merged, but the other thing that's really changed is that the dividend yield's gone up.
Yeah.
So
the individual one you had talked about, the MLPN, they got bought out by the company.
Yeah.
And I'm looking for one or two that I'm thinking about investing in individually. You have any thoughts?
I buy the whole basket. Yeah, typically I buy the whole basket. There's actually I have an ETF too. I'm not as enthused about the ETF as I am the basket. But if you want to call me in the office and I can go into more detail with it on that particular thing. But I do own both in there, so it's I've got a good exposure to that, probably more than I should. And quite frankly, it's been holding my portfolio back. In fact, the last 3 years, anything that wasn't large cap or dividend weighted has lagged the overall market, or wasn't market cap weighted. And we've got a bunch of information on that. Those cycles can be very long, and it aggravates the living dog out of you when you're in the down cycle. But at some point in time, it should bounce back, and it should be pretty good. That's why I was saying I think these Department of Labor rules, it's just luck, by the way. They came out with these things that require you to carry almost every asset class, and a lot of the asset classes that have not done that well are in those categories. So when they come back around, I think people are going to be very happy that they're doing that.
Right.
And I even put a Department of Labor model together using a tool that used to run tens of thousands of dollars. I mean, it was unbelievable how expensive these things used to be. And now I get this thing for like $3,000 a year. That's it. Mm-hmm. How'd you like to be in that business?
No, thank you.
That would be rough. So anyway, we've got these tools that they're really cool. It cuts down on the amount of effort, and now I can just concentrate on reading the management's description of the strategies rather than having to read through all this other stuff. Because I set up the software to screen for the things that are most important, things like expense ratios, the risk-adjusted performance, not just the highest performing funds with the cheapest expenses are market cap weighted indexes, but they drop 50% or so every few years. Yeah, that's a little rough.
Yeah.
So don't want to go with that. But I think we're going to bring all this stuff out. I think it's good. It's coming at a good time. I think people are going to be very happy in the next 4 or 5 years. Most people don't have a lot of international emerging market because they've been doing so poorly. That's not always going to be that way. A lot of their markets are older than ours and have better long-term track records. So when you look at valuations that are lower than ours are, and the fact that they have underperformed, it makes them more attractive. If they were also very attractive 3 years ago, and they haven't kept up. But they've started to move this year. They're starting to close that gap a little bit. So it might be might make really good timing.
And a second question I have, Bill, I'm in your dividend model, and not even a year, and I'm doing very well. Very happy about that.
Right.
Would you consider that your dividend model a value model?
Yeah, it's a deep value model, and that's been the best performing category of the past 4 or 5 years. There are some others, by the way, that I really, really like that would be in addition to that. And I wish I'd have thought of them first.
Okay.
But they're available, and I can use them through anybody's platform. They're very low cost. They're transparent. You know exactly what you own and how they're picking the stocks. So I think it's going to make a nice addition to the Bullington Capital dividend model, because that one's aggressive. That's an aggressive model. These are slightly more conservative, but their numbers have been very good. And I get it. You know, when I read the management's description, I understand it. That goes a long way towards being successful with that stuff, is being comfortable with it. And being comfortable means you have to know what they're doing. That's the only thing I don't like about mutual funds, regular mutual funds. You really don't know what the managers are doing, because if you read carefully, they all give themselves the ability to do things that are not on the management description. It's kind of like there's a caveat there. You know, we can do this is what we're going to try to do, but we may do this, or this. And great. So you really don't know. And with this stuff, you know exactly what it is, and they're really inexpensive. I mean, a lot of these things are only the super expensive ones are like 40 basis points. You know, so
that's very nice.
Yeah, it's pretty cool. So, but hey, thanks for calling, and
you're welcome.
Have a good weekend. Hopefully, we'll see you soon.
Okay, good talking to you.
Thanks.
Thank you.
You too.
Bye.
And going to Rick. Rick, you have a question for us?
Yeah, hi, Bill. Do you have any thoughts on Twitter?
Other than they are not profitable yet, here, I'll pull a chart up for you. When a company's not making money, okay, the only thing you really have to go on is what you think the general consensus is of all the investors in the investment universe. Because when it's not making any money, or if they don't have sales that are growing real fast, if the valuation's really high, the odds are against somebody making a lot of money on that. Doesn't mean that it won't happen. It just means that the odds are not very good. So the odds of a company like Twitter, for example, to do maybe as well as I don't know, just take any blue chip that makes something that you use every day, Procter & Gamble, the odds of them doing as well as Procter & Gamble over the next 5 years or so are probably pretty remote. So, but on a short-term basis, you know, I own a lot of stocks because they're in a trend, and I have this small portion of my account that I use for trend following, and I like it. I can tell you it's a personality issue as to whether or not you're going to be successful doing that, because the math is not real difficult. And when I look at that, you look at Twitter, it may come up on that screen at some point in time. Now, I might buy that just because of the price action, but I promise you, it's not a large percentage of my money. It'll never be, because it's too aggressive, it's too risky. And I'm going to have a clear exit point, a point where if it goes down to this level, I'm out. See ya. And when that happens, it will probably cost me less than 0.25% of my net worth. So I can take a lot of those small losses. It's kind of like you know what it reminds me of? It reminds me of a clothing store company. They buy all these garments. They buy the ones they think they can sell and make a profit on, right? And when they can't make it, if it sits there on the shelf for too long, they'll start dropping the price on it. It's got to go. It's costing you space. It's costing you money. You got to, pay the electric bill on that store. Eventually, they got to cut their losses and move on. That's kind of what that particular style is like. And I can tell you that's difficult for an awful lot of people. That's probably one of the more difficult strategies psychologically. Mathematically, intellectually, it's not so hard. Actually, I have a website that teaches that. It's called Look Out for the Bull. The training section of that website is like, I think it's less than 3,000 words. It's just not, it's just not a lot, but it's easy to say, difficult to do. That's how that works. Kind of like dieting. If you want to lose weight, eat less, and exercise more, right? Everybody knows that. Try doing it sometime. I struggle with that every day. That is a really tough thing to do. But and that's kind of what following trends is like. It's, you know what you're supposed to do, but getting yourself to do it consistently is kind of the trick there. So, but anyway.
Okay.
But I hope that
all right.
helps a little bit. If Twitter goes above 1978, by the way, there are a whole bunch of old school technical analysts that will probably buy that stock. So it's kind of good to know that kind of stuff. It's called support and resistance. That's really old school. If it breaks above that level, it might run up to $25-26 or so. That's how they would look at it. I'm not a huge fan of that. I know why they're doing it, what they're doing, but I'm more of a trend follower than a pattern recognition guy. But I hope that helps. I'm sorry, I probably confused you, but but feel free to. And by the way, at the next workshop, I always start off now 15 minutes before the actual workshop. I'll show people what I'm talking about like that. If you want to come, you can even ask me. I'll pull Twitter's chart up and show you where those areas are.
Okay.
So, but appreciate the call.
All right.
Have a good weekend.
Thanks much, Bill.
Yep, thanks.
You too.
Yep.
Bye-bye.
I know it sounds like running in circles. I've been doing this for a long time, and I've learned an awful lot of things. Many of them are not very useful, by the way. You put in a lot of time, and it's just not that useful. In fact, markets have really changed over the past 5 years. I don't think a week goes by that you don't see at least 4 or 5 new funds being introduced. I'm like, holy cow! That's you don't see that many new stocks coming into the market, but you see 4 or 5 new funds. And that's been going on now for, over a decade. And quite frankly, some of them are actually pretty good. A lot of them aren't worth investing in my opinion. But some of them I really like a lot. In fact, the caller was talking about my dividend model. There's a fund out there now that's very similar to that. Extremely similar. There are a couple of them that I'm going to use in this new model that I was talking about. I really like them. They make perfect sense to me. They've had very good track records. They've got low expense ratios. They're tax efficient. That checks all the boxes off. The only thing that you have to be wary of is they're still stocks. And stocks fluctuate, even the good ones. Even the good stocks fluctuate a lot. And but I really gotta believe that what the Department of Labor has been doing has been driving me nuts. By the way, we have been working like crazy to get compliant with this new Department of Labor rule. We've always been fiduciaries. By the way, part of the preparation was taking the class to become an accredited investment fiduciary. That's an accredited investment fiduciary. I was already required to be a fiduciary before I took these classes and before this Department of Labor rule, but now they're actually putting some requirements behind it, and I'm looking at the requirements. Most of the time the government's got involved, I haven't been real happy with it. This, I got to tell you, I really think it's going to help people. I really do. I think it's going to force people to be more diversified. I think it's going to change the way that they actually start to look at investments and analyze it in some cases. Some people won't. Some people are going to ignore it and flout it, and they won't be in the industry 5 years from now. And they won't care, but they might not care. I don't know. But I think these rules are really beneficial. I think people are going to make more money. They'll keep more of the money that they do make. All around, I think they'll be more successful. So we're unveiling a lot of that stuff at the upcoming workshop. You can go to my website, bullingtoncapital.com, click on seminars to find out more about it. And I hear the music. That means I got to take a real quick commercial break. I'll be back after these messages. And we're back. Hey, phone call, question, comment, feel free to reach out. Bill at Bullington Capital is my email if you want to email me. If you'd like to call us, you can go to my website. The phone number is up there. It's bullingtoncapital.com. You can sign up for that workshop that's coming up pretty shortly. And again, we've got a lot of stuff to go over. We've been working overtime over the past 9 months to bring a lot of this stuff up. One of them is, we're going to focus on this at this upcoming workshop. One of the things we're going to talk about is getting your home organized financially. We have a service available that's going to be, we're rolling it out to our clients this week, actually. So be looking for your email. If you're listening to this, be looking for it. And it's going to allow you to log in and see all your accounts in one place. It's going to allow you to track your spending if you want to do that. And by the way, all this is voluntary. You don't have to do any of it. If you don't want it, then don't worry about it. But if you do, it'll allow you to track your spending. It allows you to track things like your home's value. You actually have to manually update that. But if you've got wills, trusts, you can get those digitally scanned. We can do that for you if you're a client. We can put it up there they call it a vault, a digital vault, so you have access to that if you need it. It's really cool. You can pull up all kinds of reports. It's all online 24/7. I think it's awesome. I've been killing myself in my office. My coworkers are killing themselves learning how to do all this because we have to be able to answer the questions and support it. And everybody's been working at putting in extra effort. So it's a big deal. I think it's really going to help people. Because realistically, the two things that you need to know how to do, first thing you need to know how to do is live beneath your means, not within your means. You got to live beneath your means, and you got to figure out how to save. Well, one of the ways of doing that is to kind of analyze where you're spending the money now. That's the easiest way. Where are you spending your money? If you don't already know, and a lot of people don't, then you just start tracking your spending. There's a tool here to help you do that. It tracks it wonderfully, in fact. And you can go in and customize all the transactions to have it pull that together in a budget for you, and it'll put that up for you. So, we don't have the kind of time it takes to do that sort of thing for individual clients, but we can help you do it this way. And this way, it's pretty easy, actually. I like it a lot. Anyway, you've got a kind of a dashboard, a financial dashboard. You've got your accounts are on one page. You can see everything together. You can see which accounts you have. You can add accounts, delete accounts. You bring it into the dashboard, the home, and you see the value of everything. You can track all kinds of stuff on this. Anyway, I'll quit boring you with the details. I'll show it to you at the workshop. So just feel free to go to my website and sign up for that. I think it's a big deal. You can actually set alerts on there. Here I go talking about it again. As I'm looking at it, I see all these things that it's really powerful. Key contacts. Who does somebody contact if something happens to you? You can put that up on your website as well. So it's really comprehensive. I think it's going to be a great thing to do. Most people should be doing something like this, just because it's easier than it has been in the past. We've tried this several times, and I got to tell you, the software that was available to us just wasn't ready for prime time. Now I really believe it is. So that's one of the things. The other thing is that we've been talking about this Department of Labor rule. They're going to require that you carry a certain amount of asset classes. And if you don't take some of the recommended models, it's not that you can't, it's that you have to sign a letter saying that, yes, I understand that I'm not following the suggestions and I'm including these investments along with the other ones. Okay, that's all. And that's really what it comes down to. You just have to know what you're doing. So somebody comes in and it's got a big position in something, and it's doesn't fit into prudent investment standards. And I'll tell you typically what that is. Somebody has 25 or 30 or 40 or 50% of their money in their company stock. That's a bad idea. I don't care who the company is. That's a bad idea. You got more than a maximum of 10% of your money in one company. You're taking a non-prudent level of risk. The risk is too high. And I see this I've seen it over and over and over again in my entire career. Nobody that worked at GE in the 1980s ever thought anything was ever going to go wrong with that company. Let me say that again. Nobody who worked at GE in the 1980s ever thought anything would go wrong with that company. GE is $27 a share today. Okay, GE back in 1999 was $60 a share. Okay, that was 1999. I don't know if you've looked at a calendar lately, but it's 2017. Okay, and that is not a split stock. That's the actual price. It got all the way down to right around 5. Got down to right around 5. So it lost, at one point in time, it was down 90%. And if you look at how it did all throughout the 1980s, nobody thought that stock could go wrong. They couldn't go wrong with that. People had way too much of their money in that. And that's just one isolated incident. I can name at least 24 companies in Northeast Ohio where the same thing happened to people who worked there. So we're not allowed to do that anymore. You know, if somebody has more than a 10% maximum position, we basically, if the red flags go off, you better be footnoting that. In fact, the advisor had better have in his files a letter that shows that you agreed to keep that despite your being given advice otherwise. Just not that safe. And in fact, there are a lot of the models that I run, 44 stocks in the high dividend model, they say that's under diversified. What? Really? I got I got all the major sectors represented there. What they're really saying is, look, it's okay to use it. You're just not, we don't want you to put 100% of somebody's money in there. We do not feel like that's prudent. And I'm saying, okay, well, they're not saying you can't use it. They're saying that if you're going to use it, you're going to have to use it sparingly, and you really need to get some other asset classes in there. And firms like Morningstar that sell the consulting services for stuff like this, they're making a lot of money because they're the ones that are providing the detail, and I'm sure they're invested somewhat in the development of the regulations and guidelines as they're being published. And I have to tell you, they've improved. Over the years, it's improved. I remember one of the main reasons that I left to start my company years ago was because I wanted to use exchange-traded funds, and the firm that I was with said no. They just said flatly, no, you're not going to use it. It's been the fastest-growing segment of the financial services industry, the managed money portion of it specifically. And there's a good reason for that. With computers today, you can run models, back tests, you can figure out things. What you normally figure out is that stuff that makes common sense has a tendency to work pretty well. That's what you generally find out. And I think it's that's evolved to the point now where, if you can dream up a particular strategy, you can find one, good, bad, or indifferent, by the way. Just because you dream one up doesn't mean it's a good one. And just because it's not a good one doesn't mean it doesn't already exist. That is that's one of the conundrums involved with the stock market. Anyway, but there are some good ones. I mean, really good ones. And I look at what they're doing and going, wow, that's awesome. Now we have access to these tools, and it's easier. You can sleep better knowing what you own. I think in fact, over the next few shows, I'll bring up some of the material that I'm talking about here today. Get a little bit deeper into it. It's not super deep. Like if you look at the dividend model I run, basically I take the 11 sectors that make up the stock market, take the 4 highest dividend yielding ones in each one of those sectors, and that's about it. We equally weight them, by the way. That's kind of a big deal. It's equal weighted, and it's logical. You look at the past performance, it's been pretty good. Makes sense. So we can include that. But you're going to have to include some other things, and I think I have about 2 minutes left here, which I will not be able to talk about, but we'll talk about this every week going forward because there are some opportunities out there that I think are really good over the next 4 or 5 years. And I'm not talking about get rich quick. That's not it. We're talking about solid, prudent investment strategies you can use to help improve your performance. And all you can do is try. That's one of the other things that I think people need to come to grips with. All you can do is try. All you can do is do your best. If you're satisfied that you've done your best, then you got to be satisfied. You don't have to be satisfied. Then you should be satisfied with your effort. The results, if you're not getting the results that you want, then you should go back to the drawing board. And maybe the results that you want aren't even attainable. But if they are, then maybe you have to change your methodology so that you can reach those goals. When what you're doing is not working and you've given it a really good effort, then maybe you should change what what you're doing to try to achieve those goals. And that will be a continuous process, incidentally. That's as markets change and evolve, it's going to have to change. This is the latest iteration of change. Even if you're late to the game, it's generally not too late because they generally don't change dramatically overnight. The change is relatively subtle and it's slow, but it is significant given a long enough time period. Now that I hear the music, that means my show is over. Feel free to give me a call, reach out, contact us through the website, sign up for the seminar. Have a good week, everybody. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Good investing and good luck.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.